but the millennial retirement plan will be the reverse mortgage.
Yeah.
I mean, for most people, my age, where are you going to, a lot of people don't have retirement savings and things like that. So if you own a home,
it's almost like having a whole life insurance where you borrow back from the insurance policy.
I mean, I think that very well could be the retirement plan for a lot of millennials is a reverse mortgage. Well, assuming it's still around, or assuming we're still here. And
it's not going to be Social Security.
Yeah, well,
because
that's what I'm saying.
There's no money left in that.
Yeah. I mean, I don't even, especially, that's fixed incomes. That's where you're hurt the most when it comes to inflation.
What's the 5 P's? Do you remember it?
Proper preparation prevents poor performance.
There you go. It doesn't matter how much money we get. If we don't close, it's no money, right? So no close is no money. I'm everything that I am because of my dad's death. And I wouldn't be as successful without his death. All right, welcome to the Jason Theory. We have a returning guest with a new shirt on. Look at that. Look at that. Chris Delaney
new
from
shirt, new
Reside
company.
Home Loans, new company, same beard.
Yeah.
Maybe a little bit of a trim in the hair.
I usually get a couple inches off, and she just went wild.
Yeah, it is short. That's what it is.
So.
No more Eddie Vedder.
It'll come back.
First and foremost, congratulations on the company. Talk to us about that.
So I started this with a couple guys that I worked with at our last company, Molitor Financial. Worked together with those guys probably 10 years. And, with the lending environment changing, obviously interest rates, a lot of different stuff was happening. And we just decided it's the next logical step in our career. And at Molitor Financial, we were mortgage brokers. We really liked that model. I have a lot of friends that work for, your big retail lenders and things like that. And I love being in the broker space, not only because of having the different options, but just being able to help more clients. And typically costs can be a little less, turn times can be a little faster at times depending on volume and things like that. So just all around, I love that environment. And the guys and I, we crunched all the numbers for months and months and months, and just came to the realization, like, this totally makes sense, right? We'll never have to work for another company again. This will be it.
So do you have, it's a big move putting your own company together.
Mm-hmm.
Now when you wake up, do you there's not another person that's kind of riding the ship or doing that I just have to kind of show up, and you still have to do what you do. We're still in sales. Right. But what is the extra stress like for you owning your own company?
It's funny. I really don't feel any more stress than I felt before, right? Because when you're commission only, that's your income structure. Whether you're a W-2 employee of a company or you're self-employed, it's just like being self-employed. So that aspect of it hasn't changed at all. The only extra layer, and I wouldn't even call it stress, is just the additional responsibilities as a business owner.
Yeah, that's stressful.
Which having two partners helps divide that up. And the nice thing is, we never sat down and said, you handle this, Chris, you handle this. We just naturally fell into those roles.
Of what your personality
right.
is.
So, I handle all the social media stuff and need to do more of that, but I'm working on it. And Ben handles a lot of the payroll stuff, and Josh handles a lot of the HR type stuff, and we just collaborate on a daily basis. And it's kind of funny is we all work remotely.
That's what I was going to ask you. Do you guys brick and mortar?
We do have an office, which right now is in Northfield, right off 94. Everybody works remotely.
Yeah.
We need an office space. We have it. We'll eventually get an office in the city. We're just biding our time.
Your processors, everyone else is remote, so you guys are all okay.
Yeah. So, and it's pretty much our original team from the last company. We brought them over kind of in stages. So everybody's very familiar with each other in the process. And, it's been great. I don't know a better way to describe it. I wouldn't say there's an extra level of stress at all.
Did you work from home when you were at Molitor too? So is that not changed?
I did pretty much. Yeah. I just, I would go into the office every once in a while, but I function a lot better when I'm getting work done just on my own and in my own space. Especially when you go into an office when there's a lot of people tend to ask you questions and things like that, and it interrupts your flow.
You're not a collaborator.
Well, I can collaborate with people, but if I'm just, if I have to get in the zone, I got to knock these things out.
Yeah, no one bother me.
I need to make sure I can focus on it. So
that's awesome. What are the goals? What's the 5-year goal for your company, for Reside? Have you guys sat down and thought about this? I know it's just a lot just to do that, but there's got to be, is there a vision? Is it to stay small? Is it, hey, do we want to add, hey, we'd like to add 3 people. Like for us, I know what our goals are and kind of where we want to be in terms of adding people. If we do want to add people, what kind of people we want to add. Are you looking to grow in-house in terms of bring people in and train them? Are you looking, hey, this guy's a great mortgage broker. Hey, have you ever thought about being with a smaller shop and having a little bit of control of your income flow and stuff like that? Have you ever thought about growing that way?
So our goal with this was to keep it small.
Okay.
We're not really looking to recruit loan officers and things like that. Based on the projections that we made and the volume that the 3 of us have the capacity to do, we feel that's more than enough. In terms of growth of employees, our idea is we grow our business collectively rather than saying, hey, all these people work with me, all these people work with Josh, all these people work with Ben. We're going to individually do our own things. Well, now we're going to grow as a team. So instead of, hey, you just have 1 loan officer to work. Well, now you've got 3. And then we're going to bring in support staff, processing staff to help with that flow as we grow. That's our main goal.
Do you guys sit down and say, hey, this is what, have you ever had, you guys are new, but at some point you're going to have that discussion where someone is not pulling their weight.
Yeah.
It's going to happen. So do you guys have a structure set up that, hey, listen, this is what we expect all of us to do, a baseline. Especially if you're collaborating cash wise.
I don't know. Oh, you're talking about the 3 of us?
Yeah.
So the way that we have it set up is so that, there is some kind of equal distribution based on the amount of work that we're each doing, as well as a kind of a, 1/3 split.
So if you're slammed, let's say you got 10 clients, another client comes to you, you would say, hey, I'm right here for you, but I'm going to hand you over here. I'd sit next to him. We're perfect, but this, because of my workload right now, he's going to handle your loan. Is that how you guys would do that?
We could.
Okay.
Yeah, we definitely could. The thing about these guys is, and you never get to know people the way you get to know them when you go into business with them. But I think the 3 of us, one of the reasons this is a good partnership is we all put so much pressure on ourselves, just as is, to provide for our families,
yes,
and things like that. That it's, we're naturally going to, we don't need to hold each other accountable because we hold ourselves accountable enough. But as far as employees go, we've other jobs and things like that, we've seen how those things are handled, and we don't ever want it to get to that point. So, luckily our team is fantastic. Some corrections here and there, nothing major, not like anybody slacking or anything like that, but always just trying to tweak the process, make sure that, our team is functioning well, that everybody's on top of stuff. And if it ever gets to the point where we bring somebody in that's not,
cutting mustard,
right, we'll address it directly, right? And that's part of being a business owner,
yeah,
right? And Josh is our HR guy, so it's on him.
That's it. You fire. You have that talk, and I'll post it.
Yeah. I'll put it on Instagram or TikTok.
Here's your firing. This is how we do things at Reside. You're out. All right. So crazy times. We've got the Feds obviously being pressured to cut rates, thinking that that's going to solve everything. Obviously, we know whatever the government does, you're going to have. I mean, we just had this conversation in my last podcast. Like, whatever the government does, the opposite reaction is going to happen, right? For instance, the changes that are going to happen this Saturday, the 17th, is meant to help the buyer. The buyer's getting screwed. Prices are going to go up because commission is not going to be compressed. Now people on the sell side are going to ask more for commissions, and buyers are going to say to their buying agent, now you owe me 2.5, you get 3. It's a mess. We can't let them aggressively cut rates again. It naturally has to happen. We need the 10-year to naturally go where it should go, and the traders know best which risk they want to take. Mm-hmm. How do we, I don't think there's an answer, but how do we unwind? How do we get this money off the streets?
I think the problem is the only comparisons that we have are the past, and I don't think that past economic downturns and booms and everything else can quite compare to what's happening now, because when you look at the data, the consumer looks strongish still, but you have to really dive into it to see what's really going on. And then you also have, the idea that the data that we see is an aggregate of the country, right? But inflation, for example, inflation is different on the West Coast than it is here in the Midwest and the South. And there's no perfect answer on how to do it, but I think if we were to go back, when the Fed started raising rates in this most recent cycle, is they started too late and they went too aggressive. They should have started much earlier.
And let people unwind.
Right. Well, and then you also had that period between, 08 and up to, I think it was 2018-ish when they started raising rate, but they held rates near zero for so long. And that's almost why I think you didn't see, typically you have a recession about every 10 years or so. And that's why we had such a period without one. And then as they started to raise rates, the cracks started to show. COVID kind of exasperated that. And we have kind of a mini recession, but I think we were headed in that direction.
Yeah, 16, 17, and 14, 15, and 16. I remember those years. The 3 years before Trump got into office were rough. Mm-hmm. I remember that because I was like, okay. And then you had some exuberance. You have anytime there's change, people are like happy this, or this. And then all of a sudden you get into COVID. And it's just like, I think we didn't have a recession. What we had was just an explosion in debt to create no recession. So now we've got this debt bubble that's just so incredibly crazy. And if they're, the only positive I see on the rate cuts is maybe people can refinance out of this debt. But I don't, that debt that's floating, what's that really going to do? What is a 0.5 point going to do to floating debt?
Well, on a mortgage, I think it's all relative to the loan balance. But for instance, if you could consider like a cash out refinance to consolidate debt and convert that 20% credit card into, 6.5%, 7% over 30 years. You're not eliminating debt. You're just
managing it.
You're managing it and you're giving the consumer more money. The problem is, what'll happen, especially if things get tight and people pay off those credit cards and they need money, where are they going to go?
Back to their card.
Back to the credit cards. Obviously, the Fed starts cutting rates, that'll help with some of the credit card payments and the interest rates on those.
But then what does that do to inflation? That's the problem. The problem is the inflation is that hidden tax, that hidden killer. That it's like, how do we get out of that? How do we get from lowering rates and helping people unwind out of debt, or like you say, restructure that debt, and really, I mean, like you said, taking that credit card, doing a home equity, and just making that debt manageable, which is a great idea to do, but at the same time, not accelerate prices. Because I'm telling you, the minute this thing hits mid fives, what's going to happen to home prices, dude?
It's
going to be insane.
It's going to
People
be,
don't. It's like we're like caught in this conundrum.
It's going to be a continuing crisis for a number of years. Yeah, very long time.
I mean, we need ways to produce more energy, not less. Like, this may not be the best time to say, hey, let's cut back on all energy. Just may not be.
Sure.
You know, and if we can get more energy out there and more home production, right? And then all of a sudden we start lowering these costs. I mean, I think then you can be like, all right, we've got costs lowering. Like, you know, these Fed numbers, these inflation numbers, people are like, oh, it's under control, it's 2.9. It's like, dude, you want under control? We need -5.
Yeah, but that's what it's. 2.
You posted that.
2.9.
You posted that.
Yeah,
you posted that. I'm like, and I was like, yeah, like you and Jason post the same stuff, which is crazy. You guys should be like, I always look at both of your guys' stuff. It's great.
I have commented on some of the stuff.
Yeah, and it's just like, I'm like, no, this is still rising.
Right. Well, and I always think about what, you know, when the Fed's mandate, which is stable prices and maximum employment. But that's kind of a loose term, right? 2% inflation means they want things to essentially cost 2% more every year and keep that consistent. So that's the stability there. And maximum employment, I mean, what is maximum employment? As many people employed as you could possibly get. But what's the number? They don't have a number on that.
Yeah. And it's, you know, all we really have to do is not print money. We could have no inflation.
Yeah.
We had no inflation until the Fed decided to start fucking with stuff.
Yeah, and sending checks to households while production.
But I'm talking
about
like we had no inflation, like literally. I mean, up until Nixon, there was no. The dollar in 1930 is the same. The dollar was worth the same in 1950.
Yeah,
a dollar now is worth 25 cents in 5 years. I mean, it's just nuts. So like, what do you, like, by looking at the charts and studying the market, what do you feel will happen to home prices? You know, you said you're starting to already see an uptick in your business, and you're basically the leading indicator.
Well, I think it's what we've been telling everybody for the longest time is if rates keep coming down, right, that just creates more demand on an already limited supply of homes. But I think it's also regional too. So I saw some chart this morning of active listings across the country, and you see across the South.
The South and the West, their inventory year over year, because I just did a post on it, it's like up almost 35-40%.
Yeah.
But Chicago over the last 5 years is down 66%.
Yeah.
The Midwest and Northeast are a nightmare.
Well, and that's even with people leaving.
Yeah.
You know, leaving these areas and moving to these other areas, which is interesting to me.
I always say that. Who the hell's moving here?
But I also wonder, I'd have to look at the data, but is the rates of development in those areas compared, you know, to the different regions?
So you cannot get a permit. And I think this is what you're talking about.
Yeah.
Think about what you're saying. I don't know about the West Coast, but I have to think that when you get south, getting a permit is a lot easier than getting a permit in Chicago.
So I can just tell you, Texas.
I don't know, but it's got to be easier.
Well, so we're one of the states we're licensed in is Texas.
Oh, right. That's perfect.
That was the easiest. I mean, it was just a few things to submit. Boom, you're done. Most states are financial statements, credit checks, all this different information, all these different fees that we have to pay. It takes 4 to 6 weeks for review and approval, or they come back and say, hey, we need this, this, and this. I think Texas was under 2 weeks, and it was only a few documents we had to submit. So that just goes to show you the areas where there's less regulation, they probably had increases in supply due to
the fact that they can get
buildings.
out.
Yeah, yeah.
I mean, you can't build a house. I talked to a guy yesterday, one of my best builders. He's like, I can't, from inception to the knob turning. The city's a little quicker, but in the suburbs, it's 2.5 years.
Yeah.
He goes, I'm in review for just site plans for 1 year. He goes, a guy bought a big lot, and it was big enough that he could divide it by 2 by the village. The village is like, no problem. He handed in the new surveys to the village. All he needed was a signature. Everything was done. It was 6 months to get a signature to approve a lot being broken into. That lot being broken into provides more housing, more jobs, more taxable income. 6 months just for signatures.
It's all the hands that are involved that muck up the process.
If we could just get supply, right? If we could get supply, everything would drop naturally. If people could just build more apartment buildings, more single family homes, more units, we just need density. And Chicago is terrible on density.
Yeah.
Terrible. So like you can't produce affordable housing. And if you don't have density and then you cut rates, I mean, if we could cut rates and up the supply in Chicago dramatically, they're going to offset each other. Demand and supplies can offset each other, but you can't do it. And it's really bad here. Like
it's the most basic economic fundamental, supply and demand.
The place that I go to on a monthly basis for like research, they had I actually posted it yesterday, like a heat map. And it was I posted like 40 seconds, but it's about 2.5 minutes just on supply. And literally it's Boston, New Hampshire, New York, and a couple other places, and then Chicago, Illinois. And they're dark red for under 60% reduction in the last 5 years of supply. And then like you have Texas and Florida, Tennessee, Kentucky, and even the West Coast where you have supply eaching up. A lot of those West Coast places, they were all Zoom towns, like, Idaho and Wyoming. People are building there like no one's business because people are like, oh, I'm never coming back to work. And all of a sudden like, oh shit, I got to come back to the city.
I would think that part of it may be a result of the cost of insurance, especially in the South where they tend to have more storms and things like that. I mean, it is, we had a property in Miami for a while, and I think at that time we were paying about $8,000 a year for insurance, which was more than the property taxes. And I'm fairly certain if we still had that property today, it'd probably be north of $10,000 a year for the insurance.
Well, my insurance is going through the roof.
Yeah,
in Chicago.
Mine's gone up.
I'm like, what is going on? They're like from California and Florida.
They're spreading the costs out.
Like they can't survive.
Yeah. So I mean, that could also be part of the reason is that even though the homes down there may be more affordable, it's that the costs of owning those homes are also
really
increasing
high
down there. So,
what are you seeing most people getting into that are either refinancing or purchases? Are people flocking back to 30 years, or is it still much? Is there I saw a little bit for the first time, a little bit of a spread between the 30 and the 50 at the 15. I saw the 15. Obviously, these are just random numbers out there, but the 15 was like at 5.8, and the 30 was like at 6.5. Those things were trading at par for a while.
Yeah. The 15-year was not.
It wasn't worth it.
Well, it's also, if we're really just talking about rates and just going back to supply and demand, you go back to mortgage-backed securities and bond markets and everything like that. I mean, nobody's doing a 15-year fixed with rates in the 6 and 7s, right? So everybody's doing 30 years. So there's just not a lot of incentive for lenders to lower their prices on those rates, incentivize those rates right now. As far as refinancing goes, it's all relative to what that client needs. For most people, I would say, especially in this environment, it's probably lowering their payment. So they're going to stay on a longer term, whether that's 30 years or we do, you can do like 29, 28 years, right? So they're not kicking out the term longer. But, I've also had some clients that had some lower loan amounts. And so, they said, hey, instead of doing another 30-year, which is really only going to save you like $150 a month, which with the costs probably doesn't make sense. convert it to a 20-year, right? Payment stays almost exactly the same as what you have now, but you're saving this much on interest. You're paying down this loan faster, and you're going to
have more equity when you turn to leave. I love that.
So it just depends on the situation, and you try to analyze it as best as you can, and like on the 2nd of August when that employment report came out and bond prices shot up and rates shot down, you try to call as many people as you can, and at that point it's like, hey, here's what I'm looking at. Let's lock the rate. I'll call you back with all the details. You don't have to proceed. And that's kind of how we have to do it sometimes, especially when things move that fast.
Yeah, because you'll get a jerk the next day the other way.
Or you can it can reverse in a matter of hours.
Yeah.
So you just try to see how many people you can help, get them locked in, and then, anybody that you missed or anybody that wasn't quite there, what we've done is gone back and say, hey, we want to get you ready. Let's get all your information together. We can hold off on like credit and stuff like that. Let's just get it all together so we have the information, and as soon as we see something, we'll jump on it.
So do you have all those people do you know okay, this is where this person is, this is where the rate is? Do you have software that's being like, hey, you should call these people, their rates?
So we
I kind of like that. It'd be interesting if they could devise something like that.
With the software we have now, yes, but
the Reside
prior, like we all had Excel spreadsheets.
Okay.
Right? So I can go through and sort it by rates and see where people are at.
Just hit that little.
But then also, people's credit situations change, right? So then it's like you may not be able to do it. So you just try to advise them the best you can. And obviously, refinances are great, lowers your payment or cuts your term or whatever the case is.
Are you seeing people refi because of the economy from those 3s to 6s, just because they need to cash out or take credit card? Like, even though you're going from 3 to 6, I'm taking $60,000 of 20% debt and dropping it to 6.5, which may be worth the spread.
Yeah, well, I probably had a few. A lot of people are hesitant to do that for obvious reasons. So then people ask about home equity lines of credit, and I don't think it's a bad tool for it. But there's certainly you need to make sure you look at all the options, right? Because if you got a 3%, we're taking out a 12% HELOC or something like that, right? What's the blended rate? What are the interest differences that you're going to pay?
What is the real money cost, right?
And you have to analyze that properly. One example that I could give you is I had a client who owned a 4-unit in Roscoe Village. He had a HELOC on his primary residence.
Okay.
Because that's a second lien on his primary residence. There's no tax benefit for having that. So he had a nice low rate on that 4 flat. We did a cash out. He paid off that HELOC, and now he's got all the interest benefit.
Because it's on the,
Right. So, and he originally was going to close that HELOC, and I was like, well, you don't have to close it. I was like, you can pay it off, and it could still be there if you need it.
10 years, right? Is that
a lot of them are 10-year draws.
Okay.
Yeah, I'm starting to see some of them go towards 5 and 3-year draws.
Oh, okay.
And there's a little more incentive on the rate. Part of me thinks that the anticipation is these are going to be refinanced and combined into first and seconds, into one mortgage.
Okay.
But that's just pure speculation on my part. There's no science behind that.
Where do you see things next year in terms of rates and the Fed, and do you think that they make a cut this year?
Yes, absolutely.
Just one.
I would say it's going to happen in September.
Okay.
At least 25. At least 25 basis points. I wouldn't say I would be shocked if it were 50 basis points.
Where do the traders have it? Do they have it for 1 or 2?
I would say
they're usually pretty dead on.
I would say 1 is priced in for sure.
Okay.
I don't know that in terms of the number of cuts, I would say there's probably 2 to 3 priced in. In terms of this next meeting, I would say obviously 25 basis points is factored in. I think when that employment report came out on the 2nd and markets just went wild, it was probably, they're going to do 50 basis points. And I think some of that's probably tapered back a little bit. In terms of next year, I don't know. I feel like we're just in really uncharted territory. Even though it may not seem like it, it's just when you compare things.
Because rapids of inflation starts to tick up again.
Yeah, well, especially, in terms of housing inflation, it's naturally going to. And one of the metrics for that is owner's equivalent rent, right? And they just say, hey, what would you rent your place for? So there's not really any like fact base behind it. And that's with a lot of the data that they get.
Yeah, the unemployment number is suspect at best.
Well, yeah, I mean,
we never traded. We used to just wait for revisions.
That's
the
the thing.
The whipsaw is the best.
The revisions are
terrible.
Have been downward for how many months?
4 months in a row.
Yeah.
The revisions have been down, like extremely down.
Yeah. Well, and if you just look at, I was looking at the last BLS jobs report, and if you look at the month to month job creations, it's kind of up and down. But if you just were to take a line and average it, it's this.
Yeah.
So the job growth is slowing down, and I was also looking at another chart where it was the job openings and the non-farm payrolls and then part-time employment. And the job openings data, I think, only goes back to about 2002. And the only time that we ever really had non-farm payrolls over part-time income was around the end of COVID. And now the job openings numbers, I think since maybe late-ish 2022, are in the negative. They're starting to kind of tick up, but they're in the negative. So things are, and part-time employment's increasing too, which I think tells you something.
Yeah.
And that's not necessarily, do these people have other jobs, or are they taking on more jobs because they need more money?
Yeah, the part-time employment and government jobs are like basically what all the job creation is.
Yeah.
Like you look at manufacturing, you look at all this other stuff, and it's like that's not occurring. And the problem is that the more employers that the government employs, first off, the government right now is the number one employer in the world, U.S. government. The more employers the government employs, the more inflation we're gonna have, because the government is broke. So how are they paying these government workers? Well, they're printing money. So it's you're just feeding the beast.
Yeah.
Other than just saying, hey, why don't we lower no one wants to take that initial pain down to create just years of beautiful growth.
But it's because it's not good for political careers.
Yes.
And it's a selfish reason. I mean,
and it's our kids that are going to have the issues. Like that, our kids are not going to be able to. Everyone always says that, and I feel like I've heard that since like the 70s, that we're hurting the kids. But I think I'm starting to see that now. We're like, it's so interesting when we go somewhere and we buy something, and we'll have like 2 cheeseburgers, and Will, my 13-year-old, goes, "That was $40." I'll just look at him and goes, "Dude, this money's worthless."
Yeah.
This is worthless.
Yeah.
And people around the world are getting off the U.S. dollar as their standard. That's a problem.
Well, that's really,
that's a big problem.
That's really our backing, right? Is the faith in the U.S. dollar, and if that erodes, where do we go?
And it's eroding, right? So and I just think that people are like, how do we have faith in something that a group of people keep messing with its value, right? The Fed just keeps whipsawing the value of it, and the conspiracy theorist in me says the Fed whipsaws the value to redistribute the wealth, right? Think about it. They lower rates. People think that's good. I mean, it's going to be only good for landowners. Right. It's going to be good when they lower rates, people that have money are going to make an exorbitant amount of money. If you're on the lower end of that schedule, those lowering of rates is going to push everything out of your reach.
Well, not only that, but I mean, here's one thing you could probably look back in history and say is that, when the Fed cuts rates, right, it hurts the market. So those people invested in the market, especially on a large scale, know this information, right? So that's how that snowball effect works in the market pullback, and then they re-enter at the right time.
Yeah, is that why Warren Buffett owns more U.S. Treasuries than the Fed itself? That's a warning.
Yeah.
If there's ever a warning, the smartest man in the world owns a grip load of Treasuries.
Well, they're going to, if they start going into quantitative easing and stuff like that, they're going to have to purchase more bonds, more treasuries, more mortgage-backed securities, start flooding the market with liquidity. And
how about the fact that they print the money to buy the money?
Yeah.
Is that the most insane thing you've heard in your life? How is that?
How it works.
I know, but that's like the biggest scam.
Yeah.
Like some diabolic person was like, I got an idea. Let's just print money and buy stuff back, and we'll just keep doing that. I mean,
kind of like I suppose a form of money laundering when you think
about it. It is. And then we'll take that money and we'll give it to government agencies who then buy stuff from our friends. And then we'll just keep printing that money, which devalues the money. But the amount of money that they're spending on these certain things is so astronomical that even though they're devaluing the currency, those people are so rich, it doesn't matter. But everybody else is just getting squashed.
Yeah.
It's not like everyone's like, oh, there's no middle class because of this, because this. It's like, dude, there's no middle class because you keep printing money. That's it. It's really simple. Their value of their money, of their savings, just keeps dwindling and dwindling and dwindling. Now, if you're a homeowner, it's great because the price goes up, but is it really going up?
Yeah, but when do you?
Because the dollar is worth nothing.
Well, and you don't typically access that.
Yeah, you're not flipping it.
Equity until you sell or you retire. I mean, I'm almost convinced, and maybe I've said this before, that the millennial retirement plan will be the reverse mortgage.
Yeah.
I mean, for most people, my age, where are you going to, a lot of people don't have retirement savings and things like that. So if you own a home,
it's almost like having a whole life insurance where you borrow back from the insurance policy.
I mean, I think that very well could be the retirement plan for a lot of millennials is a reverse mortgage. Well, assuming it's still around, or assuming we're still here, and
it's not going to be Social Security.
Yeah, well,
because
that's what I'm saying.
There's no money left in that.
I mean, I don't even, especially, that's fixed incomes. That's where you're hurt the most when it comes to inflation.
And, I was thinking about too, in terms of supply, what do we do? And this is not a statement or a stance on open borders, but how do you supply homes for these millions of people that are coming over that we don't really have that capacity for, especially if we're short 4.5 million homes, which is about approximately we're short, and we're bringing in an extra 5 or 6 million people a year. How does that equate into home prices?
It doesn't. I mean, you can't. There's no way to build.
I'm just wondering how home prices go down.
They don't. I mean, again, you're going to have some regional variances.
Yeah.
But
because even if the market crashes, so if the stock market crashes, job market crashes, they cut rates. Everybody that has money is going to buy all the homes for pennies on the dollar.
Yeah.
And interest rate wise. And then just turn around and rent them. So even more of the supply is going to be ripped out. That's why I think lowering rates, I'm telling you, is going to be just like, it's going to be the devil's curse. Because it's just going to create so much supply issues. Like, so much. They have to just be able to be like, hey, if you want to build a house, or if you want to do this, you want to do this, this is how we're going to... You're telling me we don't have computer programs that could fast track this?
Listen, I think that the way the economy's headed, the only thing that the Fed knows how to do is cut rates, quantitative easing. That's what they've done for the last, 40 years or so. I wish I had the answer, because that'd be amazing, and I'd be a very rich man. I don't think that there's an easy way out of this that's not going to be painful. But I think if we can get to the other side of it, it'll be a lot better.
How do they, so in your opinion, is you saying they're going to cut rates maybe 3 times and we don't know what's going to happen in 25? Do you think cutting the rates can help that pain, or do you think it's going to cause more?
I think if they do it too fast, too fast, just like they did when the
other time.
I think
that's how they did every time. They did it
right
in 98 wrong, did it in 08 wrong, they did it not. Has there ever been a time that they did it right?
The
swings they cause.
Especially the last, 25, 30 years, it's all been, I'd have to look at it, but I think most of them
was a disaster.
I think most of them have been almost all emergency cuts to the point of getting it close to zero. And if you do it too fast like that, the liquidity comes flooding back into the market
at an unnatural pace.
So I would say, it'd be nice if they take it nice and slow, but they're always looking in the rearview mirror. Although there's probably some aspects of it that they have a pretty good handle on of where things are going. I mean, I think Powell originally said their target for unemployment, what they wanted it to get to was 4.1. Well, now we're 0.2% higher than that at 4.3. And I don't think that that's the end of it.
And that's really not the unemployment rate. How many people are sitting at home that are not considered, you're not unemployed if you're not looking for work.
Right.
Which I always thought was one of the biggest, the participation rate is much more important, because that's the people that are in the basement, playing video games. Are like, I'm just not gonna work.
I did tell my son he's part of the unemployment problem.
Does he have any summer jobs? Are you doing anything?
Give
him the coach.
So
I've coached.
So I talked to him about doing stuff like that. My wife's a realtor too, so every once in a while she'll make him help her.
Does he have his license yet?
Not yet.
Could be chauffeur.
So he'll be, the way it works here, they have to have their permit for so long. So he'll be able to get his, I think, in October.
Okay.
Or maybe it's next month. So then he'll get his, and then I got to buy my wife a new car so he can have the old one.
I can't wait for you to see your insurance bill.
I've already talked to my insurance agent about it.
What'd they tell you?
It'll go up by about $1,000.
That's it?
I mean, that's what she told me 6 months ago, so it's probably a little different now.
Mine went up $3,700.
Holy shit!
On a 2005 Mercedes with 50,000 miles, like a beater. And I say that I know Mercedes. I mean, like an old car that we just held on to.
How did you only have 50,000 miles on that?
My wife never drives.
Ah.
It may be less. It may be 30.
Wow.
Yeah. We've always lived in the city. It's
yeah.
And she worked at Wrigley. It was a mile and a half away.
Okay.
We never left Bucktown because she's like, I'm 7 minutes away from work.
Yeah.
And now she works from home. She's like, she doesn't like working from home though.
Really?
Yeah. She's like, it's just not seeing anybody. She's like, it's, you're just in this room. I couldn't do it. I would shoot myself.
Well, I'm on the phone a lot most of the day, so I'm talking to people, but also the.
Do you get out and get a walk in, get some sun?
Sometimes I have to remind myself to do it, because otherwise I stay in my office and just work if I don't have meetings or anything like that. But the guys and I will sometimes hop on Teams, on a video call just all day long, working together, going through scenarios. So that's always some helpful human interaction in a day that I wouldn't otherwise normally.
My sister doesn't come in hardly ever. She's like, I just get work done at home.
Yeah.
If I sit at home and I'm working, I'm just like, hello, anybody? Bueller?
Well, if you have a designated space,
Yeah, I don't. I have one.
So
My wife
I do.
took it over.
No. So I have my office, which is the whole second floor is, our bedroom, bathroom, and then the other bedroom that's up there is my office. So.
Oh, so you get light and it's nice.
Yeah. So
I converted a closet. There's no windows.
that's rough.
And
I've got to have a window.
The light was yellow, so everything was yellow, and our ceilings are like 12 feet. I had to go buy a ladder. I'm like, I have to change this fucking light bulb. I'm gonna lose my mind.
I can't do overhead light. I've got to have a lamp.
A lamp?
Yeah.
Oh,
or
man.
just, the natural light.
And then when my wife decided got a job working at home, she's like, I'm just going to start in the office. I'm like, it's really depressing down there. She's like, she goes down there like 8:30, comes up at like 7 at night. I'm like, how do you do that? And just talk the whole time. I'm like, I talk all the time, but I'm like, I could not just sit there in a room.
No, I have to get out at some point because otherwise I just get
Freak out.
Just burn out from being in there the whole time. So,
well, that's interesting stuff, man. I love the fact that first off, you took a step to go back and you're opened up. I know we had lunch once and you're like, I'm thinking about starting my own shop, and you did it. It's always great to be in control of your own destiny. We are, but it's even different when you're your own entity and you can do what you want to do, and you can mold the culture and what you want to define your company as. Where did the name come from? And the D is green. Is that just
that was we had somebody design it.
Okay.
So I don't know if you can kind of tell. It's kind of like a doorway.
Oh yeah, it's shadowed.
That was kind of like the idea behind it. Josh, one of Josh's friends, designed it for us. So the name, it's not like anything crazy that went into the name. We were just trying to think of a good name for a company that said what we did. And pretty much every name that we came up with, we'd Google an RD company. Like every name, right? And so I think I was on just like some AI logo generator, just punched in some words, and I'm just scrolling through, and I came across Reside, and I'm like, oh, it's got to be a company. So I look at like Reside Home Loans. I'm like, nothing's coming up. I checked the NMLS, nothing's coming up, and so we were like, that's it.
Yeah, I like
Let's do it. So just again, wanted something that said what we did, and which maybe sounds silly, but to me,
no, that's not silly.
As like the marketing guy, I felt like that was really important and just something simple. And so I mean, I like the logo. We decided to go. I feel like everybody's like red or blue or so we
green's also money.
Green. Yeah, well, I mean, it was just more of like we wanted to go with a color that wasn't something everybody. I wanted teal. That was the color I wanted.
Teal.
But the other guys didn't.
I like the green.
Didn't.
But teal pops though.
I had this vision in my head of the color I wanted, but the other guys decided green. One of them wanted a little darker green, and then I wanted teal. So I was like, well, maybe we can meet in the middle with a lighter green. So that's what we went with. Interesting. So nothing too crazy.
I like it, man. It's awesome. It's a good feeling to have like that. I don't know if it's self-worth, but like to have like, hey, this is something I'm building. This is me.
Yeah.
It's like almost owning a home. Like, this is my house. Like, this is what I do.
Yeah. And I couldn't be, more fortunate to have the guys that I'm partnered with. I couldn't do it this by myself. And, again, we just kind of fell into the roles that we're in for the company. But other than that, like, nothing really feels different. It's nice to have control because I'm very much a process oriented, especially like the actual processing. I was a processor when I started. So, making sure that process was set up the best way possible for us, for clients and things like that was really, really important. So having that aspect of control is great.
Yeah. I mean, you don't want to lose that.
No.
All right, well, we're about to wrap up. Any parting shouts? Anything you need to say?
Parting shouts.
First off, you gave us your old stuff last time. So give us your new info to reach out.
So Chris.
And I've used Chris on mortgages, so It's very good.
Chris at residehomeloans.com. And then on social media at CD Lens, which my kid always makes fun of me for, and at Reside Home Loans.
At Reside Home Loans is your other social. What's one?
Well, the company one is.
Are you posting a lot on that too? Or?
I've just got some general stuff on the Reside one right now. I'm working on other stuff, and then my personal one is obviously more focused on what I'm into, especially the economic aspect of it. So I'm working on a bunch of different stuff with that. Like our YouTube channel, I'm working on some more longer form videos. But a lot of just like standard going through the process a little bit, these types of loans, that types of loans, and then cut all that stuff up and we'll mix it all up.
Cool. All right. Well, thank you so much, Chris.
Yeah, thank you, Jason.
Interesting conversation. We both think the world's going to end. But hopefully it does nicely after we're gone. And we'll look forward. We'll be posting this first week in September. Hopefully at that point we'll do, if there's a rate cut by the time this posts, we'll do like a mini post inside the rate cut.
I think it's happening. I don't remember the date. It's not till mid to late September, if I remember correctly. So
and then we'll reconvene on the light one if they do cut. Thanks so much, you guys. Thanks for the follows, the Jason Theory, and we'll see you. Don't forget to like, follow, and we'll talk. Thank you so much for your time.